more on the worse than expected U.S. jobs numbers and what that might mean for Fed action, the economy, as well as the markets. We are now joined by Peter Schiff, CEO and Chief Global Strategist at Euro Pacific Capital in Westport, Connecticut. Peter, great to have you with us today. And I want to start first by a note that you wrote back on December the 20th, basically saying that even though they were pulling back on their bond buying through tapering, that they were not going anywhere. The jobs numbers today, is that supportive of your argument?
Well, absolutely. You know, most people on Wall Street don't believe these numbers. They're arguing that it's an aberration, that we should ignore it, it's an outlier, that it's inconsistent with the data. But the truth is, it's very consistent. We've been getting mixed data. It's just that everybody is looking at the economic glass as being half full. They're ignoring the bad data. But the reality is, whatever good data we have is a direct result of the quantitative easing that the Fed is now threatening to taper.
But when we look at these numbers, I mean, it is slightly an aberration from what we've seen over the past couple of months, the 74,000 number. What do you think might be the right number, and why isn't it possible that some of the stimulus that the Fed has put into the market has, in fact, helped? We've gotten that unemployment rate down from 10% during the crisis to a much lower percentage. Why isn't that part of a reflection of the Fed's program here?
Well, first of all, the only reason the unemployment rate has come down is because people have left the labor force. It's not that the unemployed have gotten jobs. They've just given up looking. So that's nothing that we should be proud of or the Fed should be bragging about. The only thing that quantitative easing has helped do is exacerbate the problems and reflate the asset bubbles. So, yes, it has caused the stock market to go up. It has caused the real estate market to go up. But that is masking the problems in the economy. And in fact, we don't need higher stock prices and higher real estate prices. They're already too high. We're now have a legitimate recovery as long as the Fed is concentrated on blowing air into a bubble economy. That's all they're doing. And so we're not getting legitimate economic growth. And, you know, by the way, the 74,000 jobs that were created in December, more than half of those jobs were temporary jobs. So Who knows if they're even going to be around. Meanwhile, we actually created fewer jobs in America in 2013 than we did in 2012. So how is it that where's this jobs recovery?
So
it's an illusion.
Well, so Peter, what do you think then is the impact that we'll see from the Fed in terms of their actions for 2014? Are we going to see an absolute repeat of 2013 in terms of the Fed continuing to stimulate the economy? And if that's the case, what does that mean for the market and the economy?
Well, again, it's not stimulating the economy. It's stimulating the stock market and the real estate market. It's stimulating the bubble. It's stifling real economic growth. But, yes, that is going to continue. Maybe the Fed is going to taper back here in January by $10 billion, but that'll probably be the end of it. And I still believe before the end of 2013, the Fed will be buying more than $85 billion a month in bonds and mortgages. It might be buying over $100 billion a month because the Fed is going to have to come back to the rescue of the economy or the markets with more QE. That's what's going to happen. The question is, when will everybody figure it out? When will the people buying the dollar and selling gold figure out that they've got it backwards, right? That we're slipping back into recession. And the reality of it is we are facing an economic crisis that's much worse than what we had in 2008. If you remember, when Alan Greenspan left and Ben Bernanke took his place, everybody was praising Alan Greenspan, what a great job he did, and they expected more of the same from Ben Bernanke. Well, Alan Greenspan's bubble blew up on Ben Bernanke's watch. Now Ben Bernanke has made all the same mistakes as Alan Greenspan, only bigger, and when his bubble blows up on Janet Yellen, it's going to be much worse.
So, Peter, I think, in general, you have quite an out of consensus call. So in terms of saying that the government, the U.S. government, is going to continue to not only increase, not only bond buy, but increase their bond buying program, how does that play out for investors at home right now? What do you think you should be doing in terms of really positioning yourself properly for the long term? What do you buy here and what do you sell?
Well, I'm going to keep buying what I've been buying. I'm buying the resource sector, I'm buying precious metals, I'm buying emerging markets, I'm buying stocks outside the United States. You know, Canada, you got a lot of negative economic numbers that came out today, too. You got some bad jobs numbers today. You got the housing numbers yesterday. But a lot of that is a function of unrealistic pessimism in the resource sector. When people figure out how much higher prices are going to go for resources and precious metals, that's going to be a big change up in Canada. So I think that there's an opportunity on your side of the border. The Canadian dollar got beat up pretty good today. In fact, it's the only currency that's down against the U.S. dollar, and it's probably a pretty good buying opportunity. I'm not sure how much lower the Canadian dollar can go, but I think that probably by the end of the year we might be seeing a tightening out of your central bank, because I think the numbers are going to be a lot better as a lot of maybe these unemployed people in the resource sector are going to find that their jobs are coming back, because so many people have underestimated what's actually going to happen in this sector, because they've overestimated the strength of the U.S. economy and the commitment of the Fed to take away the monetary stimulus.
Very interesting perspective. Peter, thanks so much for joining us.